There's always something.
There's always something. Welcome to the critically acclaimed Tradier's The Trader's Edge, which has recently been called Smart and Irreverent, and the two hosts being, I don't know if he said really insightful or way more insightful than they look. Which one do you think?
I think whatever makes us feel more stupid is the one we should go with, because you and I are arrogant enough. We don't need that.
Yes.
We don't need any undue compliments.
Yeah, I totally agree. Yes. Okay, so today the stock market tried to rally. I missed the last hour. Did it finish up?
So the NASDAQ finished barely above the flat line, which was really the only one that went into any sort of negative territory of note.
Yeah.
So it's as it sits right now, cash up 3 basis points. So I'll call that unchanged on the day.
Yes.
But it's definitely struggling. I mean, it failed against its 50-day today on the future side of things. So
when we talked to Mike Arnold, he said there were certain levels that had to get back up above before he would call the green light. And so far, we've not gotten above those levels.
No, we've not done that.
Is probably what we're looking for, correct?
By the way, Cisco's reporting right now, and they're going to cut more jobs, and their stock's up 4.58%. I read an article today. I did Scott Shellady's show, which you do every week as well, on RFD TV. Scott is the cow guy, for those of you that don't know. And the subject today was that companies are starting to complain that there's too many hourly workers. In other words, there's a lot of people to hire for fewer and fewer jobs. Now, my brother confirmed this in the restaurant industry, that he now has a steady stream of applications, which during the past, when businesses were complaining about not being able to hire employees, that there just was nobody to hire. My brother did point out, though, that he's getting a lot of migrant applications, which of course he wouldn't hire because they're illegal. It's not legal to hire those guys. Of course, you would never hire those guys
in the restaurant business ever.
But he said there's a bigger language barrier. My brother speaks Italian and fluent Spanish, and there's a big language barrier because of the different dialects from Venezuela and places like that. So he's struggling with some of those people. He doesn't, of course, doesn't hire them, but he's struggling to tell them why. And it's just like a strange situation in employment right now. And I think stocks are starting to struggle with this. I'm talking too much. We got to get Kenny in, but Michigan sentiment data in July came out at the lowest level in 8 months. Yeah. And we got another one coming on Friday. So it'll be interesting to see that.
Yeah, no, I don't think the economy is any sort of gangbusters too. You guys watched the show before. We appreciate it. And you know, I'll always say this, and I'll say it again, is that you can think Bobby and I are full shit, but we're honest in the opinions we give. They might be crap opinions. One thing you cannot argue is that we get outstanding guests. We've both been in the media business for 20 to 25 years each. Today is going to be no exception. We have Kenny Polcari of Slatestone Wealth, the chief strategist. Let's bring Kenny in. My friend, what is the last thing you created in the kitchen that was fabulous, and walk us through preparation?
So listen, I just made 2 things today. One, I made my Italian wedding soup because I'm just dying for some of that. But I also just made a zucchini pesto, right? Where I sliced up the zucchini, sauteed it in onions and garlic, and then put it in the food processor and blended it, and added pinoli nuts and fresh cheese and a little bit more oil. And now I'm gonna boil the pasta tonight when dinner comes, and I'm gonna make this zucchini pesto. It is delicious and simple to make. Takes you honestly all about 20 minutes.
Okay, I got a food question for you. Can I ask something, Jimmy?
Sure, of course. Yeah.
The other day I made eggs in purgatory, right?
Yeah.
L'uovo in purgatorio, as my father would call it.
Yeah.
But I left out the peppers. Like, you got to have the peppers. I don't like green or red peppers that much.
Oh, yeah. Listen, you don't have to. That's the beauty of cooking. You kind of make it the way you like it. I like it with the peppers, but if you don't like it with the peppers, you don't have to eat it with the peppers. But
I just want your okay on that, because my wife is upset.
You got my okay. I like it with the peppers, but to each its own. That's what I really think is the beauty.
And you Florida people, I'm about to play the trump card. Yeah, I do the same things, but I walk out to the garden and pick the fresh zucchini.
Oh, look at that.
Basil. Do it every day. I should bring the camera out and show you my garden right now.
You do it every day. You only do it about 3 or 4 months a year. We can do it every day.
Right now, I have the trump card, right?
Okay, so I go outside and I just pick my fresh basil because that's what I grow outside here. It's just a fresh basil. I don't have a big garden because I don't have a big yard.
Could it grow in Florida?
What, the basil?
Yeah, no,
Yeah.
zucchini, tomatoes.
Well, it could, sure. If I had I'm in a condo, so I don't have a house
don't
with my
have
own
space.
piece of property,
Oh.
so therefore I can't. That's why I'm not growing it.
Okay.
But I got pots of basil outside, so the basil, yeah, I grow no problem.
Basil, and even I can grow that. I've made so many jars of pickles from cucumbers. My wife is about to kill me. Our whole auxiliary refrigerator is filled with pickles. All I got this year is like 100 cucumbers so far.
Wait a minute. Are you making the pickles for the restaurant, or are you making the pickles because you like to eat pickles?
I just like pickles. Right? So I've made jalapeno, garlic dill. I got all kinds of them. They're all labeled. My wife's like, "Who are you?" Don't you worry about it.
Hey, so I got to say, our geniuses in production. Who should I give the credit to today? I'm going to give it to Bryce. Bryce made a really good thumbnail for this particular show, and I'm asking him to pull it up. I don't think he had it handy, but I asked ChatGPT to create a joke based on 3 Italians walk onto a trading floor. You ready? It's really a dad joke.
Yeah, go ahead.
So 3 Italians walk onto a trading floor, and the first one says, "I'll take pasta in tech stocks al dente." I don't know what that means. The second one chimes in, "I'll have a slice of those energy shares, extra cheesy." The third one looks around and says, "Forget all that. I'm betting everything on pizza futures because they always deliver." That is terrible. That is like so bad.
It went from being awful to being just kind of awful right at the end.
Yeah, but you asked ChatGPT to give you that joke, and that's what it came up with?
That's what it came up with. I literally said, ChatGPT, write a joke that starts with 3 Italians walk onto a trading floor.
So we should definitely sell Google stock.
There it is.
Oh, there it is.
I love that picture. I love that picture.
Kenny asked which one he was. Knowing our heights and Kenny's height, guess which one he is?
Tall one.
I want to know who the guy is on the right with the white shirt on with the really wide collar.
It's got to be Bobby, just because of this, right?
That's why Jimmy won't let me wear a button down on this show because I unbutton it to here.
Too much Bobby.
Yeah. No, I do that. I do the same thing, Bobby. You and I feel your pain.
All right. I've heard some people tune in to hear market talk. I don't know why, because the food talk seems way funnier. But let's talk about markets. I don't know if you heard what Bobby and I said today too. Our chief technical strategist, Mike Arnold for Path Trading Partners, talked about how 55.50 was the line in the sand for S&P. If you can't close above it, then this is just a bounce back up in a corrective phase, and we are about to roll over. I actually agree with him. I think we need to correct a little bit further to actually push the Fed off the sidelines. What's your general thought?
1,000%. And first of all, I went with the short-term trend line, which was 54.55 was the number I was using on the S&P. And actually, it kissed it and it closed right on that number today, right? It didn't close above it. It didn't close below it, but it closed right at it. I think it's going to hit some resistance there. I think we have to test lower. Look, we're in a seasonally weak time of year. You know that as well as I do. August to October is seasonally weak anyway, no matter what, right? It's seasonally weak. Last year, the S&P declined 11.9% from August 1st to October 27th, and then it rallied 16% from October 28th till December 31st, right? It does that year in and year out. You could see it. So after Monday's debacle and the screaming, my hair's on fire and the Fed's going to have an emergency rate cut meeting and oh my God, the world's falling apart. Guess what? The world didn't fall apart. The Fed held back, didn't have an emergency rate cut meeting because that would have been, in fact, if they called an emergency rate cut meeting, that would have been light my hair on fire because that would have sent a very different message than actually the message they sent. They basically said, not happening. And the people stamping their feet had to grow up and be big boys. And then look what happened. The PPI came out, the CPI came out. Suddenly everything's great. And they're taking stocks back to new highs. I think it's wrong. Wrong in the sense that don't think it's over. I think it's got to test lower again. And maybe 51.16, which was the Monday low, is the low. The 200-day moving average is right there anyway. It's around 50.50 at the moment.
Right.
So I think it's got to test that. I wouldn't be surprised if it went back and tested that kind of in a methodical way, not in the way that it did on Monday, because it broke all kinds of trend lines, which only fed the algos on top of each other. And the next thing you know, the place is falling out of bed. But
I want Bobby to have his next question, but I want to add something because I think that Monday morning from a psychological standpoint, I hope people take a big step back, because even there was a moment that I was thinking to myself, the Fed's got to cut now. And then I'm like, what? Just because I'm losing a couple bucks? That's just was asinine. But when the emotions start to pound you from the side, you come to weird conclusions, right?
Agreed. But guys like you and me and Bobby, we don't come to those weird conclusions.
No, I was there for like half a second. Right?
You almost did. You almost did, because you're a little bit panicky. But no, Bobby and I were good.
Jumpy, I like to call it. Jumpy.
Yeah, when Jeremy Siegel came on and said the Fed needs to cut by 75 basis points, I looked at the TV and I yelled, "You need to retire."
Yeah, he really does. My head blew off my shoulders when I heard him say that. He came on there, but it's over. Oh my God, dude, are you kidding me? You of all people, Jeremy Siegel. But what do they say? What's that phrase? If you can't do business, you go and teach. What's that phrase? I forget what the phrase is.
Oh, those who can't teach. Those who can't teach Jim.
right. But anyway, for Jeremy Siegel to come out and do that, I think was hysterical. I think even Muhammad Al-Arian, didn't he come out and say they needed to be?
Yeah, he said it too. He was less aggressive, but he said it.
Yeah, he was less aggressive, but he said the same thing. And I'm going, emergency rate cut says the place is on fire, and you don't want to do that. And by the way, why was the place on fire? Because all these hedge funds get into that Japanese carry trade, and then they got their nuts squeezed, and then they all had to jump out the door at the same time. And you know how that feeds. Once you start breaking technical levels, the algos then react and create more sell orders. They eliminate, they cancel all the buy orders. There's avoiding prices, and bang, down you go.
Well, just before Bobby gets in, I'm trying to bring back the word nards. So if there's any occasion again to say nut squeeze, if you could change it to nards, I'd appreciate it, Robert.
Well, you can edit that out.
Okay, we'll put nards.
Yeah, edit out the nards part. This is live, by the way, so there won't be any of that.
Yes, live, right?
Yeah, this is live. Kenny, we got retail sales tomorrow. Okay, we know that there's been some pressure on the consumer, record high credit card debt, delinquency starting to rise.
Yeah.
Used car prices dropped by double digits, right?
Great.
But also part of that is because repos are through the roof.
Yeah.
Auto repos are through the roof. So the inventories of those used cars. So in terms of the four major, I always include the Russell. Some people leave out the Dow, some people leave out the Russell. I just call it the four US majors. Where do you think a miss in either direction affects it most? Is it the NASDAQ? Is it the Russell? Where would it be?
A miss in retail sales, I think, is going to affect, I think it's going to hit the broad market, which means I think it's going to hit the S&P. But because tech is so stretched, I think tech is going to have an overreaction if that happens. The small caps, I'm not necessarily so sure it's going to hit the small caps as hard because I think that speaks more to the consumer, right? Repossessions, all that stuff. I don't think it speaks to the economy as much as it speaks to the consumer is so stretched they just can't pay at the end of the month they got more bills left over and no money, right? Versus when the other way around, where you've got money left over after you pay all your bills. And so therefore, I think that's going to be a broader comment on the broader market, just because I just think that's what's going to get hit more. And
Texas, that theory where when you start getting these losses, people sell winners to raise cash. I think, is that what you're saying?
Yeah, that's what I think they'll say. Just like they did on Monday. They sold all the big winners, right? Because they panicked. And so they sold all the big names, all of them, to try to get out in front, right? I had people call me on Monday when it was crashing down saying they wanted out. Get me out. I can't stand it anymore. What do you can't stand it anymore? Your portfolio's performing fine. We had this one day when everyone's panicking and you want to get out? And now I called them yesterday. I said, do you still want to get out last Monday? Right? Because he was a very emotional person. I'm like, no, dude, listen to me. I know sometimes it's difficult, but you got to listen. You can't react like that. But to your point, I think it's going to affect, I think it'll just hit the broader market, right? And it's interesting today because in today's CPI report, when they talked about, declining inflation, one of the things that's declining is used car prices. Great. Do you go out and buy used cars every day the way you do steak and chicken and meat and rice and fruit? No. So does it really make a difference to you that used car prices are coming down? Is that going to change your life? It isn't.
It's interesting. Yeah, it's interesting you say that too, because used car prices similar. Jimmy and some other very smart people have a theory that when crude oil goes down or up, rather, it actually becomes sort of anti-inflationary because people have to buy fuel. So it kind of takes away from their other spending. Lowered car prices, I think, does the opposite, because there are people who've not been able to change out of cars simply because of the cost of used cars. Low used car prices bring down the cost of new cars. You're already starting to see interest rate deals. You're starting to see rebates on trucks and SUVs and the like. So that could leave consumers with a little bit of money they maybe otherwise wouldn't have. Does that make sense to either one of you?
Yeah, that might. But I still think, even though used car prices are coming down, remember they got really elevated.
Huge.
So are they coming down? They're still higher than they were for sure. They haven't come down to where they were, right?
Yeah.
So
Yeah,
I
but
still
to
think
your
that,
point,
quite
Bobby,
honestly, I still think there's more room
let's
to
say
go.
if a fifth of the people need to buy a used car in a given year, and they are getting 2,000 extra bucks back for it, I don't think that's the same sort of stimulative effect as getting a $2,000 check in the mail when they were hurting back then. I think it's a slightly different thing. So I'm not sure it's that stimulative. I can't decide on that. Does that make any sense?
Yeah, of course.
Yeah. By the way, something you mentioned about the Russell, which I want to get your guys' opinions on it as well. The Russell, when the whole rotation trade began, and it was only for a couple days before it seemed to fall out of favor a little bit. One of the theories was that 3 times as many, a Russell company is 3 times more likely to use floating rate debt. Short-term interest rates going lower is very, very beneficial to those companies. So many of them are underwater based on borrowing costs. If retail sales sucks tomorrow, and we all of a sudden go back to 50 from 25. We went back to 25 today because CPI beat, but it didn't beat by enough. If we go back to 50 after shitty retail sales tomorrow, if that happens, could the Russell hang in way better than anything else because it's going to like short-term rates going lower?
I think it could. Look, the Russell's already underperforming. It's only up 2.8% this year. So it's underperforming in terms of the other indexes. So yes, if you start talking about larger rate cuts, again, that's going to send 2 messages. Does that mean larger rate cuts because we're going off the edge and we're going into a recession because that's going to hurt everybody, right? But by the way, swaps, I put in my note this morning, swap traders are pricing in a 40 basis point cut in September. Not 50, not 25, but kind of in the middle at 40 basis point, right? Which I think is ridiculous, but whatever. Which I still think is wrong. I think you should go with 25 basis points. And I don't think the Fed, depending on, retail sales tomorrow, unless it way misses, I think the Fed should just stay on track. And I think it should be 25. And then, yes, I think the small caps hold in, right? Like I said, they're already underperforming.
That's a great point. Because if there's an opportunity. 50, it might signal to some that burning timbers are falling from the ceiling, and it may trigger risk off. I agree with you.
Yeah. I think that's the worst thing they can do is last week, especially when Jeremy Siegel, again, when he came out screaming, "Oh my God, 75 basis points!" They wanted a full percentage point cut in rates. Some people, it was ridiculous.
I should take up golf. Yeah.
So I want to we have a question in the room right now from Tim.
This is a live show, Kenny. So we get questions. It's awesome.
Yeah, we get questions. I don't know if I'm trying to reach out to Bryce, and he seems to be tied up with something technically. But Tim's got a question, so I don't know if it's going to be on the screen or not. But he said HD reported HD reported really bad numbers yesterday. Why was the stock up? Now I have a quick theory. If you guys want to look at this, look at it. I'm not able to put up a Home Depot chart right now, but you got 2 straight days of Home Depot rising. And I think it's based on rate cuts, because if you want to play lower rates, you want to play Home Depot, because people buy new homes and then they go to Home Depot to buy stuff to fix up the homes, to add into the homes. They even do furniture now and grills and things like that. Whenever we go on an upturn in the housing market, Home Depot rallies. Like, you can look at a correlation to that, and it's somewhere in the 89%. What do you guys think?
I love that.
So I think you're right. And I'm just looking at this chart now. I just want to see one thing, because Home Depot, going into that report, Home Depot is down 9% off its most recent high. But I think, to your point, a rate cut would help Home Depot, right? Because whether you're buying a brand new house or you're just buying a new existing home that needs work, where you're going to remodel, or people that maybe not even selling they're going to stay in their existing home, but now it's time to remodel because prices are going to come down. So I think that's why I would agree with you that's why you saw Home Depot rally, because
I like that thesis quite a bit. And I think one thing I will point out about Home Depot earnings that came out yesterday, right? They came out at 6 a.m. Chicago time. By the way, when they came out and missed so badly, that's when the stock started to rally before the PPI number came out. That's when we started to mildly, very mildly start to take out, put back in, aggressive eases, by a couple ticks only. But I think that people thought that the Home Depot results had more sort of broad economic implication. Do you agree, Kenny?
Yes, I think that's true. But wait, I got to ask, was it their forward guidance that was negative? Because I thought they hit the number. Did they miss on the number too?
I don't know. I just read that it was a disappointing earnings. Bobby, do you know?
I will take a look right now and I'll tell you.
I'm trying to look it on Bloomberg right now. I thought it was the forward guidance that was the problem. I thought they hit on the number.
Let's see. Their earnings were $4.67 against an estimate of $4.53.
Right, so they beat.
It's a positive surprise by 3%. Right. Their revenue was a positive surprise by 1.4%. They were expected to have 42.572 billion. They came up 43.175. Right. So they didn't miss on the headline numbers. I don't know what they guided.
No, so it was the guidance was the nervousness. That was the guidance that we're going into recession. Yeah. That we were going into recession.
See, we got a new story here from Benzinga. Home Depot's price forecast lowered by analysts amid modest sales growth, citing a weak consumer outlook in their guidance.
Right, because the consumer is stretched. Right, that's what they were saying. Right, the consumer is stretched and can't afford it anymore. But if in fact interest rates come down, it'll ease some pressure maybe on some people, and they'll be able to go out and fix the house that they're in. Look,
so I've told people, whenever people want to play the Fed, I've told them for years, if you don't want to trade SOFR, which used to be LIBOR, but if you don't want to trade SOFR now and you don't want to trade the 2-year note, you trade Home Depot and Lowe's if you're trading rate cuts. That's what I've said for years. So I'm pulling that correlation out of my ass. I mean, head.
Where am I supposed to buy it? You guys have charts up right now. Where do I need to settle above to think Home Depot's going higher?
What do you think?
Let me look at it. Let me just look at it. Stay there 1 second. I'm going to pull the chart up. So Home Depot, it pierced all 3 trend lines on its way down before yesterday's earnings report. All 3 trend lines are converging, though, right at the same place at like 347. It is now above that. It pierced that yesterday. Again, today it's trading at 355. So I actually think it's on its way. I think it's already proven that the path of least resistance now is up and not down.
Yeah, Jimmy, I'd agree with that. I have a short-term target of 368 on it. It's trading about 355 right now.
Yeah. Right. The July high in Home Depot was 376, and then it sold off, and then it was an intermediate term high right around August 1st of 366. So yeah, I think that's where it's going.
Yeah, me too. Yeah, I like that chart a lot. I might get into that too, because I do think lower rates are coming. And I think after retail sales tomorrow, I think everybody thinks it already. But I actually think there is a good chance that they go 50, but that is dependent on a crappy.
But let me ask you a question. 2 things. They're going to cut rates. It's not going to affect rates on revolving credit. You think Bloomingdale's is going to cut their rate because the Fed cuts the rate? They're still charging 30%, by the way, right? or Neiman Marcus or J. Crew or Lord & Taylor or any of those companies. They're not changing their interest rate because the Fed cut rates. Is your mortgage going to change because the Fed cut rate? No. Is your auto loan going to change because the Fed cut rate? No. Is the price of food going to change because the Fed cut rate? No. So they're creating all this hysteria around the Fed needs a cut. The Fed needs a cut. Your life, my life is not going to immediately change if they cut rates, right? It's the psyche and the perception by the markets that lower rates is going to be long-term beneficial. And maybe it's true. It will be. But let's just be honest. Our life is not going to change tomorrow if they cut rates.
Interesting. By the way, I wanted to add something too, Bobby, before I give you the next question too. You guys saw that consumer, the small business optimism number that came out the other day, which was hysterical because it's clicked up kind of decidedly. And at first it was like, wow, because it usually is so very specific about if they believe there's a business-friendly regime coming in or not a business. Like this has been over the last 15 years. That chart is very political. Bobby and I and Kenny are not. We talk about policy. That chart seems to like Republicans more. So I looked at the chart, like, oh shit, that's weird. And then I looked at the survey period, and the survey period was exactly when Trump had his highest lead over Biden and Harris when Biden was leaving office. So it's like it literally was reflecting a belief that Trump was going to be president. And a lot of people are looking at it now going, whoa, see, small business optimism went up, and Harris is leading the polls. Not so fast, people. That's not what it reflects at all.
So let's see what the when did that come out? Because I'm looking for it. I don't see
I think
it.
it
What
came
date
out
did it
2
come out?
days ago.
2 days ago.
Yeah.
Small business optimism, huh?
Yeah.
Okay. I'm gonna have to find it. Maybe
Yeah,
I'm just
please
missing
do.
it.
And then look at the survey period as well. Robert?
I'm going to ask you guys about a chart that I'm going to ask Bryce to put up. Now, you guys seeing the latency here with me? Because I'm seeing it.
Yeah, a little bit of latency.
Yeah, so I'm going to ask this question, and I'm actually going to jump out of the room and jump back in and see if I can fix it. I've been
I'll take that
busy shutting everything down so that the internet is less active in the background here. But I want to put up a Cisco chart, and the reason is, by the way, Cisco is always the classic example. The classic example of when people talk about a stock that was like high flying in the 99, 2000 era that never came back down or never came back up to its price during the bubble. Like the people who are positive sort of about these bubbles talk about Amazon. Amazon used to be worth this and it continued to rally. Cisco never got back to its 99, 2000 high, right? We never saw those levels. And all three of us were around for this. I kind of like Cisco for a trade here. Okay, not necessarily, not necessarily right here.
Yeah, right.
So we've got a really nice double bottom forming in Cisco with increased volume. Now we've got major moving averages in the way and a lot of sort of hard resistance there. But I like it for a trade. Do you guys have any view on Cisco at all? Jimmy, of course, your licensing doesn't allow you to have an opinion. So I wonder if you could just
let's just pretend I don't even know what that asset is.
You don't know what's going on here.
Chart. If I look at that chart, I think if it breaks through that little triangle that it's forming now, breaks it on the downside, to me, it looks like that's where your risk is. So sometimes you enter a trade by knowing exactly where your stop is before anything else. And the stop in my mind is below the wick on the red candle from 2 candles ago.
I believe that's an always thing, by the way, is knowing where your stop is before you even enter something.
Yeah, I mean, looking at a chart and the first thing that pops in your mind is that's where my stop is. You know what I mean?
Yeah.
Yes, I agree. So I think if I was going to go long that stock, I'd be very, very cognizant of that. Kenny?
Yeah, no, I would agree. I don't use the candle charts. I'm just looking at my regular chart here on the
Whatever you think.
on my Bloomberg. But yeah, no, I would agree. First of all, you should always know, or at least have an idea of where your stop is. But listen, I think it looks okay here. I think it's building a base right in this 44, 45 level, right where it is. It's below all three trend lines. You're going to have to see it get up and test the first trend line, which is at 46. It's a couple of bucks higher from where we are today. But yeah, I'm okay with Cisco there.
Yeah, I'm talking about a target of about 48. So I'm not talking about anything crazy.
48 is the long-term 200-day trend line. That's exactly where the 200-day trend line is.
There you go. So this is just 48. A trade for me.
Yeah. Yeah, no, I think it's okay.
Do we have any way to go back and get a 5-year? Forget it. It's too late. Let's move on to something else. Yeah. Bob, are you going to sign off?
No, I'm actually good now. I don't have the latency, but I want to throw Tim's like he's a personal friend also here in Naples, Kenny. So if you ever make it over, we'll meet up with Timmy, but he says spot on rates, you Dago bastard. It doesn't matter. He didn't say that. I threw that in. But
listen, to your point, Jimmy, I went back 5 years on the chat and Cisco, and actually right where it is now is where we were in late 22, early 23. It was trading right here and it held, and then it took off. So I actually think it's safe right here.
Interesting. That's a good one then.
Yep.
Robert, what do you got?
It's funny for this show. I actually have to look at my phone too because of a bunch of Southwest Florida people that text me. One guy here says, Kenny, what is your overall view on what the Fed is going to do, not what they should do? I'm not going to say this guy's name because I call him something nasty. Go ahead.
I'll tell you what I think they're going to do. I think they're going to cut 25 in September, 25 in November, and 25 in December. That's what I think they're going to do. That's what I think they should do, and that's what I think they're going to do. I don't think they're going to get themselves backed into a corner with all these people screaming and yelling, pounding their feet. I need more. I don't think Jay Powell is going to get drawn into that. I think he's been very clear. And actually, the reason I also think that is already this week we've had three different Fed heads. Bostic, you had Schmidt, and you had Patty Harker, I think. All three of them are remaining cautious. They're not saying, oh, yeah, it's time to cut, let's go. They're still cautious, which suggests to me that they're not going to get pushed into, a much bigger rate cut than what they've already prepared the markets for. So I think they should go 25, and then I think they should do it, 25, 25, and be done with it. And that's going to take us down to, that'll take us down to 4.25, right? 4.25, 4.5.
So here's what I think they're going to do. And I disagree with Kenny a little bit too, because I think the equity market's going to play a part in this too. I believe we're at a rollover level. Like, we fought back. I think the stock's going to give up the ghost in the next week and a half. I think, and again, people, the panic on Monday was absurd and ridiculous. The notion that the Fed should care about asset prices. Okay, it's easy to say, well, it's not their job to protect stock prices, but you can twist your head and squint a little bit, and you can say to yourself, wait, if real live wealth is being created, it could in fact have implications for aggregate demand. So if all of a sudden we knock the stock markets down another 10%, that could in fact bolster the case for 50 basis point move. They'll do it because they're panicking, whatever too. But I mean, there's some thread in there that makes a tiny bit of sense. Kenny?
There is a thread in there, but you see, that's where I think it's wrong. That's where I think the Fed should do what the Fed should do, and they should be completely disconnected from what the market's doing, because because I don't think they should be connected. I think the market needs to do what it's going to do, no matter what the Fed does.
You're not going to say that if the market all of a sudden loses 40% of its value, then you're on my team, right? Then that's wealth destruction in a real life.
Wait a minute. If the market loses 40% of its value in one day, yeah. But what if the market loses 40% of its value over 6 months, over 6 or 7 months? Is the Fed, is that going to cause the Fed at one point to become very nervous? It depends on where rates are. It depends on what the market's doing, what the economy is doing. But look, there are cycles. Do I want to see us lose 40%? No, I don't. But I don't think, look, we're at historically normal rates, by the way. 4 to 6% is historically normal, right, over our lifetime. The last 16 years when they kept rates at zero, there's a whole generation of people that came into the business when that happened, and all they know is 16 years of zero rates. So 5% seems usurious to them.
Yep.
It
I
really
isn't
in the long
People
term.
Listen, I do disagree with Kenny a little bit, but I love his passion, so I'm going to have to Robert.
Yeah. So just to put a finer point on that, I think one of the problems we have right now is exactly what Kenny just said. The idea that 5% is high.
Right.
Okay. I mean, people are locked into these 1.5%, 2%, 30-year. And that, by the way, is 80% of the population have fixed rate mortgages.
Yeah.
Rates have to fall a long way in order for those people to get out of their houses, or the price of homes have to fall a long way for that too. And I think not letting the economic community normalize around this level of rates is a mistake. But I will say this. Milton Friedman said inflation is an evil worse than any other evil, right? He said it's a tax on poor people and it harms economies worse than anything else. And he included recessions and depressions in that. And I agree with him. And the reason I agree with him is that you could talk about a stock market falling 40%. That hurts the three of us more than hurts the person who's paying 25% more in their groceries and is struggling to pay their car payment because of it. So if we end up with a 40% drop in the equity market, I'm certainly not going to welcome it. Certainly our clients, a lot of our viewers aren't going to welcome it, but it's better for the overall growth. It's like trimming the fig tree, Kenny.
Yeah, listen, I'm not suggesting, don't anyone misunderstand me. I'm not rooting for 40% decline.
No one is.
No, by any stretch. But what I'm saying is, listen, do you remember when we first came into this business, what the Fed did? Do you remember the Fed never came, never spoke? They never let the people speak. Yep. And they never gave you a hint at weeks and months in advance. And this is what we're thinking. They came out on the Thursdays. Greenspan came out from behind the door. He opened his book. He said, the Fed did this. He didn't take questions, nothing. He closed the book and he walked away. And the markets had to figure it out. Now, they hold your hand. They tell you weeks and months in advance. They come lie down on my couch and take a Xanax. Oh, are you okay? Let me rub your back. That's bullshit. It's bullshit. The market should function the way a free market functions. Period. The end. That's how I feel about it.
We got a couple of comments I want to throw up, and I want to let Kenny respond to both of them. First is from CJ Mendez, another regular of ours. The consumer is stretched. Credit card usage is at historic levels. Retail data has begun to slump, and jobs, which had been steady, Eddie, in the past couple of years, have begun to show weakness. Add in a very market-unfriendly candidate in Harris polling well. I think weak economic data from here forward isn't going to be swept under the rug by the market. What do you think, Kenny?
I agree with him. I don't think it's going to be swept under the rug either. I actually kind of hope that the economic data between now and election day gets weak. I really do, put the pressure, because honestly, Don't even get me started, because that's going to take another direction in this conversation about where the election is going. But absolutely, and I actually do hope that the data gets weak and the market does have some instability going into that election, because it's all a direct result of the policies that have been shoved down our throats over the last 3.5 years.
Can I make a quick comment on that too? And
Sure,
I agree 100% with what Kenny said. I like to couch it as saying too, I don't wish economic misfortune on anybody, but I do wish for the door to be open so we can see the actual consequences of actual policies. And the timing of seeing that sometimes is good before an election, because I think the policies of the left suck. We don't talk about politics. We talk a shit ton about policy. And some of those policies are so anti-growth.
And so that's all. I'm not making a comment one way or the other, but to Mr. Mendez's point, he's right. And I hope the data does get weak as in the next couple of weeks, in the next couple of months, because it will expose the policy for what it is.
Yeah. So Widge has a comment directed at Jimmy.
Another smart guy. CJ smart, Tim smart, Widge is smart.
Yeah, spot on, Jim. The small biz stuff going to tank with these newer polls. If Harris wins, the survey is going to crash. That survey is going to crash. I'm guessing he means Michigan sentiment. No, and the Harris administration will be fine with that.
Yeah.
Oh, the small business. Yeah, you're right. And the Harris administration is going to be fine with that.
Yeah, they don't care that much about small business. They've expressed that a million times. They are big business people. That's one of the reasons that when they started selling the big tech back in whatever it was, one of those reasons was that Trump had surged in the polls because of the misfortune or whatever was happening with the president. So the market says Democrats and big tech are basically the same entity. We've seen that over the last few years. And small businesses should favor the Republicans because those policies would be better. That's all I got to say about that.
All right. The next comment's from Tim, and it's a question. I think all three of us should give our answers, starting with Kenny. What's the most important data point in the next month? NVIDIA earnings, the September 6th jobs report, or something else? Kenny?
That's a great question.
That's a great. Really Timmy's always great for this.
That's actually a great question. Clearly, I think all those. I think NVIDIA and the jobs report are going to be key. Well, the jobs report from a key economic standpoint, NVIDIA is going to be a key release, just because it's going to talk about not only the tech craze and the AI craze, but kind of what the future is. Right? I'm bullish on NVIDIA still. I think NVIDIA is going to blow it away once again. But I do think that the non-farm payroll report at the first of the month, and then the next round of CPI and inflation reports before the Fed meeting next month, which is September 20th, I think. So there's going to be one more round of inflation numbers right before the Fed meeting. But I think it's the non-farm payroll is going to be the next key that I'm looking at. NVIDIA, you're going to look at it because it's going to talk a lot about the tech. It's going to talk not only about NVIDIA, but then if it's a negative number, it's going to drag everything down. I don't think it's going to be a negative number, but remember, they priced all these stocks to perfection. So one little line item is going to cause hysteria. Look what they did to Google. They made what was the number? They made $30 billion or $10 billion in 1 quarter. In 1 quarter, $10 billion. They made $1 billion profit, first time ever. But that one little line item about YouTube revenue was going to be 30 million versus 32 million, and they crushed the stock. Are you kidding me? and I think potentially, if there's one line item in NVIDIA that doesn't make them all, happy, that they're going to do the same thing to NVIDIA, which I then would look at as a buying opportunity.
Okay,
what do you think?
I hope I can eloquently answer this and tell me if this makes sense. Okay, let's picture NVIDIA compared to Amazon. Now, NVIDIA has been the bell cow in this whole move higher. If NVIDIA reports and it's bad, it is not a broader economic implication like Amazon would be, because it's a reflection of the consumer and people purchasing. It is a reflection of the pace of AI growth and who's buying it. It's important, but it's important because of market position, and so many people are long it up to their eyeballs, right?
It's a crowded trade. It's a crowded trade.
So it could have broad implications, but only if it drags down the share price and starts destroying wealth. Home Depot and Amazon are reflections of the consumer. If they report badly, to me, it has more broad economic implications. Now, what's the most important thing? I think it's obviously the jobs number, because we have seen a string now of probably 5 inflation numbers in a row. Inflation is becoming less of a problem. That has got to be an accepted narrative. It doesn't have to, I know Bobby disagrees with it a little bit, but right now it is a more accepted narrative. So then attention has to focus to the next important thing, because the recession can't really start until the jobs market breaks up a bit. So I think all focus is going to be on that September 6th number. And I think it's going to be one of the more important jobs numbers that we've had in the last couple of years because of this shift from inflation focused to labor focused. Does all that make sense?
It does.
It does.
I think
Do
it's
you think the guy who critically acclaimed our show is right?
it
Saying
is
it was
critically
smart,
acclaimed,
intuitive?
this show. Timmy Kenny, do you know those shows are critically acclaimed?
Critically
No,
acclaimed.
who
Yeah.
critically acclaimed it?
One of our guests.
One of
said
our
we were great.
guests.
So we think he's critical. We think he's a critical thinker. So we call it critically acclaimed. I think it's 1 week after the NVIDIA earnings, which in a weird way is a cop out, because I think Kenny's right. I think NVIDIA is going to crush it, and I think they'll probably shoot up at least to about 134, 135 again, right? Which is the recent cycle high. And then I think they're going to sit, and then on the 6th we get jobs. If NVIDIA sells off after that, so something that I said and Jimmy agreed, it was Jimmy and I saying it at the time, was when we got that 3-day sell-off in the NASDAQ at the beginning of August, we were both saying, you need to buy this dip, but there's a dip coming that you shouldn't be buying. But this is not the one, right? The reason I say this the way I do is if NVIDIA kills it and they rally up and they can't hold that rally, you're going to get a raising money cycle going where people are like, NVIDIA's starting to crater, and people are like, crap, this is the second time it's cratering. The market's cratering. I got to get out of everything.
Hold on. NVIDIA reports on August 28th. That's 2 weeks.
Yep.
Right? Now, look what they've done. I'm looking at the chat right now. Yeah, it sold off on Monday. It's rallied back. It's gone through the intermediate term. Now it's kissing the long-term, the short-term trend line.
Yep.
It's still got 2 weeks to perform. If they rally it ahead of those earnings and the earnings come out and they're stellar, they could still fucking whack it and go, okay,
Absolutely.
now, we bought, it's like buy the rumor, sell the news, right? They're going to buy it up, then the earnings going to come out. I think they're going to blow it out of the water, but the trader types are going to hit the sell button and lock in the profits that they made.
Well, yeah, and the reason I say what I say is because NVIDIA didn't recover as quickly as everything else after the NASDAQ sell-off. Now, it recovered. It looks great. I love the chart right now. Yeah. But when the NASDAQ started to recover, which was really quickly after the 3-day sell-off, NVIDIA was kind of stalled there. And it was sort of like the what's the phrase everybody uses? They put it on the thing, the FOMO people. The fear of missing out people weren't jumping in like they had in the past on NVIDIA sell-offs. Now they've jumped in, and I get it, and I think they should be jumping in. I think NVIDIA should be a long-term buy and hold for a lot of people.
For a lot of people.
Depending on their age. I think the three of us are still young enough to buy and hold NVIDIA.
Yeah.
But if you're in your 70s, ignore what I just said. But you look at it from that perspective, and I think if the NASDAQ starts to cascade another time after that, maybe a November 6th job report, or even after the Fed meeting, which is longer than I stated. September 6th. And even after the Fed meeting, which is longer than what I stated, if NVIDIA starts to collapse, I think the buy the dip people won't be back in. And then you get this cascade of we got to sell winners to cover our ass on the losers.
Correct. Margin calls and all that stuff. But look, remember, we said it at the very beginning. We are in a seasonally weak time of year. Yep. I suspect the path of least resistance right now is going to be lower no matter what, right? Over time. And I think we're going to bottom out sometime in October. JP Morgan thinks we're going to test a long-term trend line at 5,000 or 5020, wherever it is right now, by the end of October. And I think they're right. And so therefore, I'm being very patient. I love the name. I love NVIDIA. I already own it. I'm not going to chase it on the way up. It was off 30%. Monday night, it was down 30%, or Wednesday, it was down. By Wednesday, it was down 30% off its most recent high. A screaming buy, in my opinion. In fact, it's rallied from as low as 90. It's trading at basically $118 right now, almost 120, and likely going higher. If it pierces this trend line right now, then to your point, it's going to go right back. I think it'll go right back towards the 135-ish, 140-ish level.
I have noticed a lot more hand movement in this show than usual.
I wonder why that is. Yeah. Like I broke 2 glasses already. You knocked something over before, didn't you, Bobby?
I did. I knocked over my cup. Thank you.
I heard the cup. I heard something.
My espresso cup. I picked it up, but I knocked it over first.
Oh, you want to hear a quick little funny Italian thing, by the way?
Yeah.
You guys are going to love it. So Saturday was my daughter's wedding. Okay.
Congratulations.
Fabulous affair. And like the two of you, I had a fantastic time, but I spent most of the time kind of walking around the room, darting my eyes around, making sure everything went well, because I wasn't going to spend that kind of money and have not everything go perfectly. Anyway, one of my daughter's friends who came from, I think he came from New Orleans, Antonio says to my daughter, because I'm there in my tux just walking around the dark, and he goes, I don't mean this bad, but has your dad ever had a job where he's had to kill people before? And I thought that was one of the greatest compliments ever. Like, aw, that's so sweet.
That's so sweet.
My cousin did something really funny at his wedding. He's a lot younger than me, and at his wedding, he had a registry, right? And he said he had two things on the area note said registry for white people, and it was Target and something else. Registry for Italian, Wells Fargo.
Oh, I like that a lot.
That's what he put on there. I was like, that's perfect.
That's really funny. Yeah.
All right. My last question for Kenny in this whole, we're still talking markets.
I got one more too. Yeah. No, we're talking mob people killing people. Yeah, we're good now though. Yeah.
By the way, after my wedding a few years back to my current wife, nobody that never met my brother believed that he was in the restaurant business. They were like, that man has killed humans. 100% he's killed them. Like, that's racist, but we take it as sort of a compliment. So it's not really racist. Well, you can't offend an Italian. It's like we sit there and be like, you've killed people, you're a criminal. Well, maybe, just whatever.
One last little comment. This is about 10 years ago. And I was telling some Medigone friends, I was just talking about a business dealing and talking about a guy who owed me money, this. And the one woman goes, hearing you talk, are you sure you're not in the mafia? And I step back for a second. I go, I am 95% sure I'm not in the mafia, but I'm not 100% sure. I've been in bed with some sleazy people over the years. This is 10 years ago.
The guys from Chicago should, when it's mafia, no. Because in Chicago, it's called the outfit.
It's called the
in
outfit.
New York, it's called the mafia. I should say on the East Coast, Philadelphia, New Jersey, that whole thing. But Chicago,
I didn't know it was called the outfit.
Yeah, they call it the outfit.
Yeah, they call it the outfit.
By the way, a buddy of mine wrote a great book called The Heights about the Chicago Heights mob.
Yeah.
Then got in with the Capone outfit gang. And Chicago Heights was this big mafia presence. He wrote a fictional novel called The Heights. Ray Franz is his name. Excellent book if you guys ever want to read it. Yeah. I had another question about markets before we go. Is that okay?
Oh, yeah, go.
We talked about tech. I think I heard you on TV. You were on just before me. Was that yesterday? I think you were talking about like things that pay a rate, utilities, things like that. Do you genuinely, or banks? What's your opinion? Like if the curve steepens, I'm long a steepener. Are banks going to do well? If rates go back down, are utilities going to do well again? What do you think?
Yeah, so I think utilities will do, and that was part of the question I think that she asked me on the Big Money Show. I think it was Jackie that asked me the question. I would expect utilities are going to do well if rates go down, because utilities are very good dividend payers, and if rates go down, there'll be a challenge. And look, I said it. I think I said it. Maybe I said it on Liz's show. NEE, NextEra Energy, is still off 12% from when they started to raise rates 2 years ago, right? So now they're going to get into this cutting mode. You're going to see NEE is going to take off. It's already rallied back, but it's still 12% below. But once they start cutting rates, I think you're going to see NEE take off, as well as some of the other utility names.
Do you know off the top of your head what it pays?
I can look right now. I'll tell you. I think it pays. I'll tell you right now. It pays 2.7%.
Okay,
right, which is it's not tremendous, but it's a great. NextEra Energy is a great energy company, and they're going to pay you to own it, like a lot of them. There are other ones that pay closer to 4%, and those will do well too, right? But NextEra Energy is one of our favorites. It's in our core portfolio.
If I believe that the yield curve is going to steepen, this question is to you, Bobby, first, actually, if that's okay. Yeah. Should I be long banks to a company by steepener?
I don't like banks right now, but I think that the first stock trade you should get in based off of a steepener. I just don't like them right now. I worry a little bit about some of the stresses. We don't have a stress situation in consumer credit yet, but we have a higher probability of a stress situation. You're seeing the consumer debt continue to rise, and I think it was CJ Mendez that said it in our chat here, that he's right, because the consumer stretched and their credit is starting to roll over and become more delinquent. So I worry about that with banks, and I worry about the commercial real estate situation, even though it hasn't hit yet. I think there's another shoe to drop there. Then after that, once the curve steepens and the recession fear starts to build, I think you buy banks then.
I think, listen, banks are up 14.5%, right? If you just look at the XLF, they're up 14.5% this year overall, right? I like banks. I like banks now. I'm not so concerned about the commercial real estate market, because the big places, Blackstone, Kane Anderson, they're all raising funds to take advantage of when that supposed break happens, right?
Yeah.
So I think there's going to be plenty of interest when the break happens. I don't necessarily think the break's going to happen, though, to the extent that people think it's going to happen. I think these guys are going to start picking up some of this distressed real estate before it becomes, before it becomes a shit show, right? I think it's built in. So I like banks right now. I like JP Morgan. I like Bank of America. The two of my favorites. I own them and I like them both. And I'm bullish on banks.
We're going to have Mitch Rochelle on soon to talk about the commercial real estate situation. I
Yeah.
think the timing is right. Mitch, Kenny, you guys are regulars to a certain degree. So Kenny, I want to ask you a question about dividends. But first I want to put up a comment that we got that I thought was really funny from Mark Riley to Jimmy. Congrats, Jimmy. Leave the gun, take the canola.
Thank you, Mark. I miss you guys. The Riley boys were my neighbors when we were kids, and they were some of my favorite people. I love that guy. His brother, by the way, was the ad agency guy who came up with the Camel commercial. Remember Mike? Remember that commercial? I can't remember who it was. His brother's an ad agency guy who came up with that. Mark, thank you for watching and for all your support. I love the Rileys.
Yeah. So real quick, dividends from a trading perspective, Kenny. So this is your personal opinion. This is not Slatestone's opinion. This is something I'm asking you from your years and years of experience. Did you know guys that bought stocks for the dividends and then got out of them? And the reason I ask that is I've never done that as a habit, as a trader, right? But I recently saw, I can't for the life of me remember what company it was, saying they were going to do an increased special dividend to anyone who owned the stock by August 16th, payable on August 22nd. Can't remember what it was.
So they bought it, so they were of record. They got the special dividend, and then they sold it. Is that what you mean?
Yeah. Have you ever known people to do that on a regular basis?
I have not, but I have
never
not.
done it.
Somebody does. Somebody's taking me out of my calls for the dividend at time. It's my short.
Remember, I spent 40 years as an insurance broker on the floor of the exchange, right?
Yeah.
So I was representing mutual funds and pension plans,
institutions,
and hedge funds, institutions, and so
you went for drinks with people.
Yeah.
One time I had covered call strategy in Apple years ago, and I let it go too long, and I got taken out. I got exercised against me, and it had like a $10,000 capital gains thing because I didn't monitor my positions. So even people who trade options every day sometimes lose their edge on that. But obviously that person took it out for the dividend. You know what I mean, right? I mean, it just got close enough. I always try to do the math of why they exercised it, but they did, and it cost me a bunch. Anyway,
There is one more comment, and again, it's actually a question, but Tim says, do any of you guys own bank preferreds? They pay 6 to 7%.
Right.
I want to get into that, Tim. I want you to teach me about those things because I want that. I'm being serious. I've never traded preferreds, but that's a nice rate they got going.
But you don't have to trade them. I think to his point, he's just saying you buy them to own them because they're great dividend payers, right? They pay that preferred rate, and so yes. But I would say that that those bank preferreds always tend to be more relevant for people that are as they get older, 65, 70, because of
not young spry guys like us.
The income that it pays, right? Right now, Jimmy's not necessarily looking for the income. So he's going to jump in and out of the more sexy stuff. But at some point, he's going to get old and he's going to get out of the sexy stuff into, the more conservative, boring stuff. And the preferreds are a great way to do that because, they don't trade a lot. They're not really active, but they pay a great dividend. And for someone that's looking for that dividend income and safety, they're perfect.
And here's what I think too also, Tim, is that Janet Yellen was very, very clear that the big banks that pose a systemic risk will be backstopped. So I think you can buy preferreds from Bank of America, JP Morgan, because eventually there's probably only going to be 10 banks in this country. And I think you do not have to worry because preferred gets paid before anyone else, right?
Right.
Before the senior security, even debt holders too.
Yeah.
So I think there will be in the next couple of years as I start going toward retirement that I will be looking very closely at those, Tim, and I'll probably come to you for some guidance on it.
There's some good things about bank preferreds, but also, as Kenny said, they're not liquid. So if you ever are going to need the money, you're likely to take a hit on it. They're also
you take a hit.
The price of the preferreds are very interest rate sensitive. There's dividend suspension risk. There is risk to them. They're not just like risk-free 6 to 7%, but they are very good investments for what you just talked about, Jimmy. And Tim says real quick, CRE is fine, Bobby, for the banks, that is. I want to throw that. Timmy's very good in commercial real estate. It's what he does. But I want to say this. I'm not saying commercial real estate is in trouble. Okay. My land is not flooded right now, but there's gray skies. Okay.
Yeah.
So I see gray skies in commercial real estate. Gray clouds don't mean rain. They mean the probability of rain is higher than it was when the skies were completely clear.
Correct.
So that's what I'm talking about with CREs. I don't want to.
You're surprised that we haven't seen any cracks in the foundation in commercial real estate up to this point, are you not?
No, I think it's been solid because of when we went through in 08. I think that just banks were a lot smarter about things. And, when I look at it from that perspective, and also, the Fed tightened up on some of these things. We have stress tests. We have all kinds of things going on to make it better. But there are a lot of smart people starting to say things. But the people who are in the business, like Tim and like Mitch Rochelle, often say, no, it's fine. But then I talk to other people. I have a friend who's involved in private equity that buys the lease deals from banks for office space. And he's specifically in Chicago. And I swear 8 months ago, he's like, oh, I'm buying things for pennies on the dollar. It's going to be great. 5 years from now, I'm going to be just waiting. And the other day, he's like to me, yeah, I'm getting a little nervous. Things are still fine, but I'm getting a little nervous. Again, he's not panicking, but he's more nervous than he was 12 months ago.
All right. Let's let everybody go here. Is that okay?
Yeah.
It's good.
Time. We're good.
Kenny, tell them where they can find you.
They can find me on Twitter at Kenny Polcari. And you can find me at Slatestone Wealth. It's just K Polcari at SlatestoneWealth.com. You can reach out to me and have a chat. You can chat with me on Twitter because I'm very active on Twitter.
And again, this was a hell of a fun conversation. I appreciate you being here so much. I appreciate all the stuff you do. Thank you.
Well, thank you. I write, and for those who are interested, I write a daily commentary blog, which is really very much like this. And you can get that on my Substack, which is just kennypolcari.substack.com. And you can just sign up for it. It's free. I do it in both written and video form. So if you want to just listen, you listen.
I read it every morning. Yeah. But finally, to you guys who are watching, we cannot express to you enough how appreciative we are of all the interaction, the DMs, the comments, spreading the word about the show. Remember why Bobby and I are doing this. When you watch our show, you are getting our opinions. You're not getting the opinions of some producer or some sponsor who's leaning on you to say one thing about something. We might be wrong, but we are being honest. And I think that there's a real thirst for that because we are so sick and tired of what we hate calling the mainstream media, but I can't think of any other word for it, where they give you a lot of pressure from sponsors and shit like that. And we are not going to stand for it anymore. That's what we're trying to build here, but none of it happens and works without you. Thanks for you guys. We really appreciate it. This has been Tradier's The Trader's Edge.
Thank you for having me. I appreciate it.
Brother.
See ya.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.